Hello Freedom Builders and welcome back to the channel. My name is Hans Nielsen and today we're going to talk about one of my favorite topics in the entire world, and that is automated investment strategies. Because if you've been following my channel here for a while, you know that I do like strategies where I don't have to think too much. And it's not that I don't like to think, but when I think, I do it before I trade. Meaning that I'm thinking when I'm constructing a strategy, when I'm backtesting and so on. And then when I have a good strategy with some solid backtest and live test, I start trading it, just executing the orders that my algorithm tells me. And that is the topic we're going into today. We're going to talk about strategies built on ETFs. And if you're not too familiar with that term, it stands for Exchange Traded Fund. And I just copy-pasted a bit of text here. I think it was from Investopedia. It says, what is an ETF? And it says Exchange Traded Fund. And exchange is, of course, exactly the same as a stock exchange. So it is traded on the exchange, but it is a fund. So it is kind of a mutual fund, but it behaves like a stock. And you can trade it like a stock. And that gives us some advantages. For instance, the people behind the ETF, they're not trying to beat the market. They don't have a ton of expensive analysis trying to figure out which stocks they should buy to outperform the S&P 500. No, there are a few people and some computers sitting behind an ETF like this, and they are just trying to mirror the market. Meaning that if the S&P 500 goes up 10%, then the ETF that follows the S&P 500 should also go up 10%. So that is a way for us small investors to buy an entire market very, very cheaply. Normally, when I follow ETFs or I want to read something about ETFs, I go into the website etf.com. And in here you can search a lot about all ETFs, and there are some you can register also. I'm not sure what you get there. I'm not a member here. I just go in, and if I want to know something about the S&P 500 ETF, I can just look under SPY here, and I get all the information in the world. I can see here all about it, how they're allocated, how they're performing, and I can see that my yearly expense ratio is 0.09%, and that is because they have almost no expenses running an ETF like this. So that is what we are building the strategies on. However, normally, if a new investor comes to me and saying, I want to put some money into the market, I normally advise them just to buy an ETF. That could be the SPY if they want to just follow the US market. It could be an ETF called, let's say, VT, which is a Vanguard ETF covering the entire world market. So that is an easy way, a very cheap way to diversify very quickly. But that is not what today's video is about. Today's video is a bit more active, because what I want to do is that I'm going to use a trend strategy on my ETFs. And as you might remember from my earlier videos about my own stock strategy, I do like to buy the stocks that has performed the best, that are in an uptrend. So what we're doing here today with the strategy that I'm telling you about here is that we are picking the ETFs that are performing the best. Let's say, for instance, that we have a stock universe of 10 ETFs, and that could be the S&P 500, the SPY ETF. It could be an ETF covering the oil market, and maybe one covering Asia, and one covering Europe, and so on and so on. And then I'm putting them in a list, in an Excel spreadsheet, and I am tracking their performance for the last 3 months and 6 months and 12 months. And then I'm ranking the ETFs, and I'm picking the 2 or 3 ETFs each and every month that has performed the best. So let's say here today, when the market opens, I am going to pick the best ETFs from the last 3, 6 and 12 months, put them into a little algorithm to see which one did the best overall. And then I'll pick the ETFs that has got the most up in price. And you might say to yourself, well, wait a second, Hans, if I'm going to pick the ETFs that has gone up the most, isn't that kind of picking ETFs that is going to drop soon? Because now they have gone up in price, so I know that prices are going up and down in the market. Well, you should think so, but let's have a look at some stats that support the way that I use my ETF strategy here. For instance, here is statistics starting from 2003, ending in 2019. I know it's not a huge number of years, but I'll get back to that later with some more stats. But here, this is not ETFs, this is picking stocks. If you, in this time span, had picked stocks that had done the best for the last 6 months, meaning that, for instance, you're looking at the entire S&P 500 index and you are picking the 50 stocks that have gone up the most in percentage for the last 6 months. Now, how would you have done from 2003 to 2019? Well, your annual return, just picking the 50 stocks that had gone up the most, would have given you 12%. Had you chosen the one with the lowest momentum, meaning the one that dropped the most, you would have only made 4.9%. You could see the difference in the overall returns here. Just picking these 50 momentum stocks, over these 16 years would have given you 567%, whereas picking the 50 with the lowest momentum would have given you 121%. You can also see that the volatility is a bit smaller, and that gives you a way better Sharpe ratio. However, still with a max drawdown of 62%, and that is, of course, because in this time span we have the 2007 to 2009 financial crisis, so you would have taken a huge beating there. So it is not a foolproof strategy, but it's just to tell you that just picking high momentum stocks, for instance, or ETFs, can be a very good strategy to use. Also, I have some further statistics, because you might say, well, we have had some good bull markets here in 2003 to 19. So how about some more stats? Well, I can give you that. Here you can see US large cap momentum. If you would have bought large cap momentum stocks, we can see here it is divided into 10-year time spans from 43 to 52 and so on up to 2012. So this is ending 8 years ago, but still it gives us some very good idea as to how momentum strategies would have performed since Second World War. So let's see. We can see that here we have low momentum and we have high momentum. So they have, instead of just picking the 50 best or the 50 worst, these guys have split it up in 5 different parts. So we have the 20% up here with the highest momentum, then the 20% with the next highest, and so on down to the 20% with the lowest momentum. So had you from 1943 to 52 picked stocks with low momentum, you would have made 9.7% per year. Had you picked the one with the highest momentum, you would have made 21.3%. That is an 11.5% difference. And again, in the next 10 years, from 53 to 62, the low momentum stock would have given you on average 3.3% per year. High momentum would have given you 19.2, and so on and so on. Out here you can see the difference, and in every 10-year period, the high momentum stock would have beaten the low momentum stocks. That is quite thrilling for an automated investor like myself. You can see here that overall, over the entire time span, you can see the low momentum stock would have given you 4.5% per year, the high momentum 15.1. And you can see the overall stats down here, that is a different from the highest quintile on 6.6%. So that is very, very good. Okay, another thing, by the way, you can see that overall the high momentum and the next high momentum is actually that's 0.2% difference. So it might not matter if you're picking from one of the two here, But that is, that's just a detail here. The ground rule here is that things that has gone up in price tend to keep going up. But of course, in times like 2008 and so on, you will get a beating because you are picking stocks that has gone up a lot, and then the market drops, and of course, then the stocks that has gone up the most often are the one that takes the biggest beating. So in the big crashes, you will get a beating, no doubt about that. All right, this was back from 1943. I also have one back here from 1926, actually. Had you only bought momentum stocks, the stocks that has gone up the most, you could see that we have the overall market, the gray area here in the back. And this green line is actually if you had chosen to put $1 in the market and just keep buying the best performing stocks, you would have outperformed the entire market with an amazing amount of percentages. Not necessarily, this is 7.4% each and every year. Maybe that doesn't sound too much, but over a 100-year time span, it gets absolutely insane. So what am I doing? Well, what I'm doing here is that I have built a little algorithm where I am picking ETFs, just to cover a broader market. I don't want to be in specific stocks. I'm just picking ETFs. So I'm picking ETFs that has done the best, and I'm ranking them so that I have, for instance, 15 ETFs covering pretty much all sectors of the world. And I'm ranking them in an Excel spreadsheet, and I'm looking at the momentum there, that just their core percentage performance over the last 3 months, 6 months and 12 months. And I'm also taking some Sharpe ratio into consideration, meaning that I'm also going for, let's say I have 3 ETFs to choose from that are doing very well, then I'm picking the one with the lowest volatility because I want as straight as an equity curve as possible. I can tell you that this strategy has performed quite well. I have tested it back from 2006. That is where the ETFs I'm using, they have all started there. And in that time span, the strategy has made just about 13% each and every year. That is with a max drawdown of 12%. So even though the strategy has also run over 2008 and 9, where the crash was, I can tell you that the strategy in 2008 actually made 11.45%. So in a market that ended with, I think it was minus 36% for the S&P 500, this ETF strategy actually rotated, because it's rotating every single month, it rotated into ETFs that were rising. That could be gold, that could be some bonds, that could be different sorts of instruments that actually were doing well in a crisis. So in 2008, it made 11.5%. The only losing year since 2006 was actually in 2015, where it made an astounding minus 0.9%. It is almost minus 1%. It made in 2015. It's not beating the market every single year. For instance, in 2019, it only made 10.3%, whereas the market were up something like 25%, something like that. So it is not beating the market every single year, but having a strategy that over the last 14 years have made 13% per year with a max drawdown of 12%, that is quite amazing. In January here, this year, 2020, with all the coronavirus and volatility and so on, it made 0.85%, so a bit less than 1%, which is absolutely acceptable. So running my chosen ETFs through the algorithm this month, it is actually putting out these ETFs. And I can say right away, just remember, I'm not a financial advisor and so on, but I'm not going to give you these ETFs every single month because I am not a financial advisor. I am not a financial advisor. You should do your own research and so on. So if I'm putting out the the ETFs I'm choosing every single month. I am kind of advising you as what to do. But I am going to let you track my portfolio, and I'm going to show you live from my account from month to month how it has performed. But you are going to get the ETFs that I'm putting my money in this month, and that is in February 2020. And my little algorithm, ETF Spreadsheets, have put out that I am going to put 66.6% of my money in the SPY, which is of course the S&P 500. Then I'm going to put 16.60% in GLD, that is the gold ETF, that is tracking the gold prices. And I am going to put 16.8% in VNQ. And if you're looking at the VNQ here, that is the Vanguard Real Estate ETF. So it is going to put a portion of my money in real estate. So if I am going to track this one with 100,000, for instance, I would be putting 66,600 in SPY, 16,600 in GLD, and 16,800 in VNQ. In a month's time, I run all the numbers again, and it might be that the GLD and VNQ should not be replaced, but maybe I should sell all the SPY and buy some other ETFs for the money from that. So each and every month, I'm running the calculation, and I'm only rotating once per month, no matter what happens. And that can be a bit psychologically hard. It can be some sort of mental strain, because you might be looking at your ETFs just dumping down in a big black hole during the month and saying, wow, I wish I could go out here. But it is important for me to follow my rules 100%. So from month to month, I am going to tell you about the performance here so that you can get an idea as to how an automated ETF strategy runs. I'm also going to let you follow some of my other strategies. I am building a US stock-based strategy I'm going to let you follow. And I'm actually testing right now a day trading system. And I know that is a kind of the opposite of what I'm normally saying, that I want to get rid of my screen time. But I am testing a day trading system. Not that I want to be a day trader, but I am testing as many systems and strategies as possible. And when I run this day trading strategy, it's running in Forex and different markets. And when I have about a month of performance there, I'll let you know how that one is doing. It is a service that I have been given. I've been allowed to test it with some education and some daily market advice, and let's see how it spans out. Right now, I have only been testing it since last week, and I am up something like 2%, 1.8% or something like that. So that is actually quite okay. So if any of you should have any interest in being a bit more active, aggressive traders, there might be something for you on this channel after all. All right. That's all for now. That was just an introduction to the ETF strategy. I will give you more details about the strategy and the content and so on, and there will be more ETF strategies. I have 8 or 10 quite solid strategies with different, you could say, aggressiveness towards the market. So I am gonna slowly put more and more of these strategies in, so you can follow them. And I might even on my I'm starting up an English website, and I think I will just let you have all the stats in there as well. All right, that's all for now. I'm looking forward to tracking all of these strategies live here on the channel and with real money, so that you can see it's not just some paper trading scam. All right, thanks for now. Remember, if you haven't done already, subscribe to the channel, hit the like and bell notification, all that down there. And I'll talk to you again soon. Bye for now.